Okay, now that we understand the basics of the conjunctions or singularities coming from the triple STXs themselves, let's take a moment to delve further into the dash shadow line and how it can form yet another variation of the conjunction. As you can see, the shadow has been designed to be a very fast and responsive element in the triple STX study and very responsive to price action itself. This means that the most shallow and fastest of the retracements can often result in the shadow line reacting back to one or more of the STXs, as was the case here. Small retracements will result in a shadow being contained by the fast STX. And let's see if we can find a few examples of that. Here's another case where we basically had the transitioning phase going on and the shadow line came right back in as well. What will generally happen is that small retracements will mean that the shadow will be contained by the fast STX, while somewhat larger retracements may bring the shadow into conjunction then with either the medium or slow STXs. The deeper the countertrend retracement, the more likely the STXs themselves are to come into a conjunction with one another, as we've looked at previously. And then, assuming that the trend remains intact, and as the retracement then reverses back to the thrusting direction, the shadow line will make itself an abrupt reversal turn and cross the STXs, returning to this fan formation that we discussed previously. Here's a situation where we in effect come into a triple conjunction by virtue of the STXs and the shadow line at the same time, giving us in effect a quadruple convergence at this location here. Here's another location where we had the overshoot of the fast STX through the regular STX contained by the slow, all residing with the shadow line coming into the same singularity. And that was the case here as well. So what we can see that as you come back here, assuming the trend then remains intact, and as the retracement turns around and reverses back to the upside, the shadow line makes this abrupt reversal turn, as was the case here, and here, and here. A little hard to see, but more than 90 degrees in these cases, and very quickly returns to this fan formation that we discussed previously. In fact, the very nature of the angle of that turn in that shadow, and particularly in that formation right there, can be instructive as well. The more powerful the thrust, generally speaking, the sharper the shadow reversal angle is likely to be. This can often be a very subtle indication as to the ensuing price action to be expected to occur, but very important nonetheless. In the case of a true trend reversal, however, the shadow doesn't, and this was a case where at this point, for instance, all we knew was that we were coming back into this singularity potentially here, but the shadow doesn't make the sharp turn, and prices and the shadow itself simply continue their newly established direction, which was the case in a location like this. In this case, there are likely to have been many other Ocean Pro tools that will be of great aid in anticipating that situation, and we'll be exploring those in due time. All right, the next benefit of the triple STX worthy of discussion is the ability, by virtue of the way it's constructed in the indicators, is this ability to have 3 different degrees of a stop available to you. Remember that since the fast STX remains closest to the price action, when a move seems to be getting ahead of itself, it can be used as an exit for some of all of the position, as circumstances might dictate. As we'll see, several of the other Ocean Pro tools can be used to gauge these levels of overbought or oversold that the market may be exhibiting, and the tighter versus looser stop that we're talking about here and that the triple STX generates can be employed as market conditions dictate. For instance, in extreme overbought or oversold situations, and again we'd use other oscillators looking at them to see whether or not they've exceeded their respective upper or lower standard deviation bands, you might choose, for instance, to use the fast STX as a location to, say, take a third of the position off, while using the standard medium speed STX to scale out of the second third, and finally to employ the slow STX to close out the remaining 1/3 of the position. It's just an idea, but given the flexibility that the triple STX offers, I'm sure you'll be able to find many creative ways to weave it too into to your analysis process. And let's just take a few examples of this. Here are cases where, for instance, the market is grossly ahead of itself. Now, we're never going to let that much profit be given back, but here's an example of how the fast STX is residing much above the regular STX and would have provided a better and tighter stop, at least for a portion of the position. And notice that on a closing basis, even the slow STX was not penetrated, thus allowing you to potentially hold the trade a little longer, and this is going to be the topic of another discussion in just a moment. Here's another example of it occurring. Here's another example where it was true. Another example where we had a much tighter stop available to us by virtue of the fast. And again, the way I would want to utilize this would be to be looking at situations where I know I'm already deeply overbought or oversold to begin with before I choose to employ that as a method. We might go over and take a look at a couple of examples in TradeStation and see how applicable that might be as well. This is on a weekly time frame, so is really not a good method to gauge this, but you get the idea of what I'm talking about. Here's a case where, because of the nature of the calculation of the fast method, it was far superior in terms of an initial stop, at least for a portion of the position, than would have been the case with the regular STX. And again, this idea of being able to scale in and scale out may be of some virtue to you as well. Here's another case of it here as well. It's just an idea that I'd like to see you apply. Now, in a discussion of stops and the virtues and benefits of the triple STX, there's another utility that the triple STX offers that comes to mind and that you should be aware of. That is the scenario of these 1 and 2 bar penetrations of any of the STXs as potential re-entry points. So, for instance, here's a location where, as we're trying to transition here, we first get above the regular STX shown in cyan, and then we get a 1 or 2 bar penetration of it. The market then thrusts to the upside. Note that we come back and we get a 2 bar penetration of the regular STX right here. The market then moves higher yet again. We come back down again. We get a 2 bar penetration, in this case of the STX calculation again. We thrust back to the upside. We once again come down and we make this 2 bar penetration of the regular STX. We make a small thrust back to the upside. You have to remember this is on a weekly chart. And now we pull back yet again, and at this point we actually get a 1 bar penetration of the slowest, that is the slow STX. That was also true, by the way, back here and in this location here as well. Here's a case where you were coming into a singularity and you got the 2 bar penetration, and you see these all the time, by the way. It's very, very common. Let me go to a daily chart. Here's a 2 bar penetration of the fast STX. Here's basically a 2 bar penetration of the regular STX in a downtrend, and the market reverses from there. Here's a case where you had a 2 bar penetration of, in this case, the regular and the slow STX, and then smartly reversed. Again, the situation took place here. It was present here as well, and here. And it was true in this location here as well. Let's see if we can see any of those on the Trade Navigator platform. Same situation here, more or less the same situation here and here. You get the idea. Basically what can happen here is that we get into a situation where other ocean tools are going to tell us more about the quality of those deeper retracements. Almost always what's going to be happening there is that those are going to be identified as either NMC or NMC2 zero hits anyway. So really what you're looking for are these minor penetrations of either the fast or regular STX is simply because the higher order, that is penetrations all the way back to the fast STX, or slow STX rather, are going to be covered by, in most cases, NMC or NMC2 zero hits. What you can do is you can think of these retracements that penetrate fast or regular as, in effect, quasi-NMC or NMC2 zero hits. And oftentimes an NMC or NMC20 hit may be occurring simultaneously even in that scenario as well. But when they aren't, it's still a message that you might want to roll down to a lower, first employ other tools, or then maybe roll down to a lower time frame to see if a higher quality setup may be developing. And or you could use some sort of a rule-based entry like violations of the high of a low bar for a bearish counter trend reaction within a primary uptrend, as was the case in this scenario here, or violations of the low of a high bar for bullish counter trend reactions within a primary downtrend. And even the use of tools like the NST at the time of the STX penetrations may allow you to pinpoint viable trade locations. As you explore this pattern, I'm sure you'll be able to find several possible ways to exploit this quick price action penetration of the STX that may occur.